Hi, I'm Ed Alexander, founder of the Entrepreneurship Law Firm. In this video, we're going to talk about how to estimate early stage value. In the last video, I talked about the investor's perspective on actually making an investment, so it's important to take a look at that before you look at this video. Now, when an investor makes an investment in a company, they should be taking a portfolio approach. Professional investors do this. They know that while they can probably pick out the investments that are going to fail and not make them, obviously, what they can't be sure of is the ones that are really going to win. And so when they do that, they'll take a portfolio approach, meaning that they'll typically make let's say 10 investments in 10 different companies. They know that 7 out of those 10 investments are going to die over a period of 5 to 7 years. That 2 of those investments are going to return moderate returns, nothing to write home about, but enough to return the capital from the company. And typically one of them is going to be a home run. And that one home run makes up for all of the losses and the moderate return. Now they know that with that home run, if it returns at least a 60% compounded annual return, they'll be at or better than even. In other words, they'll have made their return that they need to their investors. Now, typically, they need to make a return to their investors of about 20% or more a year. And so that 60% compounded annual growth rate, after deducting all of the losses, brings them back to that point. Now, of course, there's no limit on the upside. So this means that home run could return 100 or 200% compounded annual return, and then their overall return would be great. Let's say, for example, you're looking to raise $500,000. And you're looking to do an exit 5 years hence. And if you look at your pro forma financial statement, your EBITDA, your earnings before interest, taxes, depreciation, and amortization in year 5 is about 3.3. And you know that when you sell a business, that it's worth a multiple of its EBITDA. So let's just say that if somebody comes in and buys your business in year 5, they'll pay 4 times that EBITDA number, that cash flow number. Based on that, you know that your business is worth roughly $13.2 million. Now, as we said before, an investor is looking for 60% compounded annual return, which means that for each of those $500,000, they're going to expect $10 back. Or in other words, in year 5, they're going to expect $5 million. This means that the value of your company can be guesstimated, and it is a guesstimate, by taking that $5 million and dividing it by the total enterprise value of $13.2 million. So in this case, that would mean that the investor would get approximately 40% of the stock of your business for a $500,000 investment, and that the post-money valuation of your company would be roughly $1.26 million. What's important about this is that it is a guesstimate. It is not a hard and fast rule. Plus, you can't just manipulate the EBITDA in year 5. You've got to have a reasonable basis for determining that the cash flow coming out of your business is going to be that $3.3 million. And of course, the investor may disagree with you and may reanalyze the company, and that's part of the negotiation process. We've now valued the company. In our next video, we're going to talk about how the securities law affect your search for growth capital. Thanks for watching.